Well, hey there, it's Terry Sawchuk. It's Thursday, so that means it's time for 3-Minute Thursdays. And I want to talk about really what's driving the market right now and why we've had a bit of a run up in the market and how you can tell like what the relative move is and why it's kind of taking place, right? So let's just start with the CPI data this week came in a little bit benign. And what I mean by that is it wasn't like it just faded. It's just that it came in line with expectations. And so the market was more worried about what happens if CPI comes in hot, right? Then all of a sudden the Fed might not be as committed to cutting rates as they were. Rates could stay higher for longer, and ultimately that might not be good for the stock market. But lo and behold, shocking, we got inflation data that was relatively benign. It was in line with expectations, so there was no outliers, no surprises, and the market reacted positively. But most importantly, what you need to look at is the 10-year Treasury, okay? And so as the 10-year Treasury yield essentially has gone down, okay, the stock market has gone up, and the move is commensurate, okay? So what's most important right now is what the market perceives Fed Chair Powell and the Federal Reserve, what it's going to do as it relates to interest rates. And so with the 10-year Treasury at 4.35, which is where it's currently at, and the market having a nice little bounce from, it was probably close to 5,000 up to now 5,300. And it doesn't show it on this chart, but because it's moving in percentages, but that's the move. Actually, if I just go to the S&P 500 here, you can see that this move was, I need to get rid of, let me do this. Okay, so you can see that the move was from roughly 49.60, and it's currently at 53.22, so a little over 300 points. But that move, when you look at it to the 10-year Treasury, it's the same basic shape and size as the drop in interest rates. So this is clearly the only reason that the market went up the way it did is because the 10-year Treasury came down. Why? Because the CPI number and inflation expectations came in line with what the expectations were, and so it paved the way for the market to move up a little bit. This is not the start of a massive bull run. This is just a reaction to what the Fed did with interest rates, or the market perceives the Fed's likely to do with interest rates. And there's still hope, as far as the market is concerned, that the Fed's going to cut 1 or 2 times this year. I'm not necessarily sure that it will, but it's still on the table. And as long as it's on the table, the market's going to be reasonably happy with that. So in the short term, as long as we don't get a big spike in interest rates, and the only thing that would really do that is if the inflation data keeps coming in hot, and it's not likely to come in super hot. It might not slow down as fast as what people would like, but I don't think it's just going to keep shooting higher. And unemployment, even though it's not moving a lot, there's a lot of job losses that are being announced right now. So these are things that aren't necessarily moving the unemployment number down, but we're trading really good jobs for not so great jobs, and that's not going to be good for the economy long term. So, I think in the short to intermediate term, there's room for the market to do reasonably well. I don't think it's going to go a whole lot higher, but it could push a little higher, and there's room maybe for interest rates to dip a little bit more. But as soon as rates start going back up, the market's going to go back down. So this is what we have to keep an eye out for. I hope that helps, and I'll look forward to seeing you next week on 3-Minute Thursday.